The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Carolyn Roth. These are your headlines. UK Chancellor Rachel Reeves unveils a series of revenue-raising measures in her autumn budget, pushing the tax burden up to an all-time high. Markets cautiously welcoming the plans, with borrowing costs falling and sterling driving higher.
These are my choices. Not austerity, not borrowing, not turning a blind eye to unfairness. My choices are a budget for fair taxes, strong public services and a stable economy.
Puma shares jumping in pre-market trade on a report that China's Anta Sports is eyeing a takeover bid for the German sportswear giant. Airbus CEO Guillaume Faury tells CNBC aerospace and defense firms are lining up for a new space race, calling on Europe to scale up and become a leader in the sector.
What we've decided to do with our friends of Thales and Leonardo to create a satellite manufacturer and operator that will have the scale to compete with the bigger players around the world.
UK Chancellor Rachel Reeves has delivered her long-awaited budget, raising billions in new taxes to build up a fiscal buffer and pay for increased welfare spending. But the Chancellor's announcement was overshadowed by the unprecedented early accidental release of the details of the budget and the economic forecast that underpinned it by the Office for Budget Responsibility, almost an hour before Reeves began her speech. Those forecasts showed a weaker outlook for the UK economy. Growth expectations downgraded for each of the next 4 years as the OBR lowered its forecast for the UK's productivity. Speaking in Parliament, Reeves said the government is working to improve the growth outlook.
We beat the forecasts this year and we will beat them again. By boosting trade, not blocking it, by increasing investment, not cutting it, by championing innovation, not stifling it, by backing working people, not making them poorer.
The tax rises announced in the budget are forecast to total £26.1 billion annually in the 2029 to 30 tax year, adding to the £40 billion of tax hikes that Reeves delivered last year. That is projected to push the UK's tax burden to over 38% of GDP, a new post-war high. The increased tax level comes from what has been described as a smorgasbord of measures after Reeves reportedly ditched a plan to raise headline income tax rates. The three biggest revenue raisers, income tax thresholds, will remain frozen until 2030 to 31. Tax benefits for pension contributions will be cut back, and income tax levels will rise on property, savings accounts and dividends. The OBR says the Chancellor's tax changes will create £22 billion of headroom against her fiscal rules, the most left by any Chancellor in the past 3 years, and more than double the amount forecast in the spring statement earlier this year. Ian King spoke to the Economic Secretary to the Treasury, Lucy Rigby, and asked about the decision to keep tax thresholds frozen.
Well, we've been clear that we've stuck to our manifesto, which is what everyone, of course, wanted us to do. We have had to freeze the thresholds. You're absolutely right, and the reason we've done that is to try and make sure that we are keeping taxes on working people as low as we absolutely possibly can. And you'll remember that's what we said in our manifesto. That's what we committed to do. So you're right that there is an increased burden, but what we've done with the package that the Chancellor announced today is to keep the burden on working people as low as we possibly can.
But is that really true? I mean, if you look at the OBR costings, 980,000 people are going to be dragged into paying the higher rate of income tax by the end of this Parliament. That doesn't feel like a budget for working people?
We've stuck to the terms of our manifesto, which is what we set out to do. We've kept the burden of tax on working people as low as we possibly can. And today, the Chancellor was able to announce, she told the Chamber, that growth has been upgraded. And of course, you will have heard the Chancellor doubling down on all of the conditions for future investment and indeed for future growth. And there are a myriad of ways in which we are doing that. She's also made a priority of this budget getting debt under control. It's really, really important that we do that. So debt's going to be falling in the last couple of years of this Parliament. And as I said, the Chancellor's made a priority in this budget getting our debt under control.
And let's take a quick look at the reaction when it comes to UK asset classes. And most importantly for Rachel Reeves, borrowing costs fell across the board. We saw that in the case of the 10-year, but also the very important 30-year. When it comes to the 10-year, we saw a dip on the day to the tune of 6 basis points, currently sitting at 4.42, but also a pretty positive reaction when it comes to the equity markets. The FTSE 100, of course, more internationally exposed, up by 0.8% on the day, and the FTSE mid 250, that of course is a better reflection of the broader UK equity market, rallying to the tune of 1.3%. Lots to digest here in terms of the winners and the losers, Karen, but also sterling dollar seeing a little bit of a bid throughout the trading day yesterday, though that was more pronounced in the run-up to the budget rather on the day itself. And of course, we did see a whole lot of volatility given the earlier release of the OBR figures. Now, I want to show you the 10-year gilt once again intraday, and what we've seen again is that drop when it comes to the borrowing costs. And interestingly, Karen, in a note from Deutsche Bank, they say that yesterday marking the largest fall in 10-year gilt yields on the day of a UK budget or a major fiscal statement since 2006. Why that strong performance in UK assets, or fixed income rather? They say, of course, it is the fiscal headroom that you talked about, £22 billion. Only 5% of their surveyed clients were expecting a figure north of £20 billion. So that was quite sizable.
Carolyn, the reality is the Chancellor did not spook the bond market, so got away in terms of landing this budget, but not without a hitch. She mentioned that the OBR forecast that came out earlier, where someone looking at that as just more shambolic behaviour from the government, and what we saw from the OBR forecasting here. I think for the market that was looking for a smooth sailing, some credibility here, how much was really stored in terms of fiscal credibility? Some of it good enough short term, but long term, if you look at the reaction from those who are watching FX, those watching the bond market, saying it's backloaded in terms of some of that fiscal tightening here. So there could still be an issue as we count down to the next election to have left a lot of those hard elements to the real back end of the government's tenure here. Can anybody really imagine that the government will be tightening going into an election? Will some of these sacrifices actually be revisited down the track? And I think that is what's fascinating, that there was some chortling, that you've got a government going into what we already know at this point is going to be a tough election given the fragmentation in politics. Is this budget really going to be good enough for them as they head towards the next election, Carolyn?
No, I think you make an excellent point here. Also, I would argue there was maybe a more cautious tone coming from Berenberg. They say the fall in yields and the strengthening of the pound probably is more due to a waning of political risk rather than any changes to official forecasts or policy changes, because the likelihood of this government falling apart has materially waned, has materially fallen since the budget yesterday. Was it an all-out market clearing event for Chancellor Rachel Reeves? Probably not, but it gave her some breathing room, just as her fiscal space was given some breathing room as well, Karen.
Yeah, you do wonder if the Chancellor slept well last night, but did anyone else? Workers, businesses, savers, those are heading towards pension years, those with EVs, large homes. There was a lot of extra tax in that budget for everyone. Well, let's get to Mel Stride, who is Shadow Chancellor of the Exchequer, UK Conservative MP. Thank you so much for joining us today. The Chancellor described the budget yesterday as credible and a fair budget for working people. Would you agree with that?
No, not at all. This is a huge tax grab, a lot of it landing on the shoulders of working people. So one of the things that she's doing is extending a freeze of the allowance, the thresholds for income tax, which will drag probably 1.5 to 2 million people into higher tax brackets through time. And if you look at where she's spending, because she's doing quite a lot of spending as well as additional borrowing, it's in the area of welfare, so spending more on the benefits bill, which is not really the right way of aligning the correct incentives in the economy to actually drive growth. And that's what you're seeing on the growth front, is all the forecasts are looking at more anemic growth going forward, higher inflation, lower living standards compared to the spring statement in March. So no, I don't think this has been the right thing to have done. What she should have been doing is controlling government spending and actually getting taxes down as a means of growing the economy.
I want to get into that growth story a little bit more with you, because the Chancellor was promising more growth. And as you look at some of those forecasts, very bleak as we look out onto the horizon, what would the Conservatives have done differently here in terms of adding some growth drivers? And what, let's face it, was a very difficult backdrop to try and bring a budget?
Well, it was a difficult backdrop because of what she did in her first budget, which is to load up businesses in particular in the UK with lots of additional tax, and that's been part of the growth destruction story in the United Kingdom. What we would have been doing would have been getting on top of the size of government spending, particularly welfare, where we have elements of the welfare budget that are really spiralling out of control. We've got around 3 to 4 million people on health and sickness benefits, no conditionality attached to them, no requirement to look for work and so on. And really tackling that is absolutely key. And we recently set out, in fact, a total of £47 billion worth of savings across government, 23 billion from welfare and billions from other areas of government to fund both bringing down the deficit, because we've got a very high debt to GDP ratio in the UK, but also bringing taxes down as well in order to get growth going. And if you look at those rather weak growth forecasts that we've just had from the OBR yesterday, a lot of what is driving that is this increasing tax burden that is now going up to the highest in our history, that is weighing down on growth.
Sir, you talk about a growth destruction story. Didn't that start with your government?
So we had particular challenges around the COVID pandemic, which shrank the economy by 10% overnight. We had to spend a lot of money to support jobs in particular. We had, of course, the energy price shock, the inflation that came through the Russia-Ukraine war. We had to get inflation down from over 11% back to target at 2%, and that came with a price tag, and that did mean some difficult choices, particularly on tax. But on the day of the last general election, we had the fastest growth in the G7, near record level of employment, near record low level of unemployment, and of course we had inflation bang on target at 2%, and it's almost double that at the moment under this government. So I think we had turned the corner, but it hasn't taken this government long to actually put all of that substantially into reverse, which is why you're seeing the kind of figures from the OBR that we got yesterday.
Sir, what was positive in this budget? Because what the Chancellor of the Exchequer arguably has delivered is some stability to the public finances, and she's been able to regain some of the trust that has been lost in the bond markets.
So I think some of that trust has been lost over the last few weeks and months because of the extraordinary level of speculation, leaks from the Treasury, kite flying of different things that might be happening, U-turns on what might be going to be occurring in the budget. And I think there is a kind of collective sigh of relief that at least we've now had this event and we know what we're dealing with. But at the heart of it, as I say, I think are the wrong choices, particularly for the medium term, because what she's done is she's increased borrowing every year on average by about 11 billion. We're already borrowing a huge amount of money, about $500 billion over the 5 years compared to the plans that she inherited. That and putting up the taxes, etc., is going to come at the back end of the period, the spending at the front end of the period. So I think the market's going to be looking very carefully through time at how sustainable that approach and how deliverable that approach actually is.
Let me ask you about the early release by the OBR, because many felt as though the government lost the narrative yesterday. It had a very difficult day delivering this budget. Already there were concerns in the bond market, but the early release just seemed to add to what was a very shambolic lead up to this budget. Long runway, U-turn after U-turn, and now the early release. It meant that before the Chancellor even got to the dispatch box, that others were just raking over what went wrong at the OBR. What would you say about that in the process?
Well, I mean, it is totally unprecedented for that to have happened. And as you say, it came on the back of weeks of speculation of kite flying and leaks from the Treasury and so on. And it was a very, very difficult and bad moment. Apart from anything else, of course, the OBR report contains a lot of market-sensitive information, and therefore its release in a controlled and appropriate manner is particularly important. So I think where we are now is that there needs to be a thorough investigation. The OBR themselves are conducting that. We need to get to the bottom of exactly what happened and to what degree this was just a rather catastrophic mistake or something more than that. And we need to know the answer to that in order to determine where we should go as a result, I think.
Well, thank you so much for joining us today on the Wash Up from the Budget. And we do hope to have a longer chat with you too at a later date. Mel Stride with our Shadow Chancellor of the Exchequer, UK Conservative MP.
Let's continue. JP Morgan has announced it will build a new 3 million square foot headquarters in London in a project that it says could contribute the best part of £10 billion to the local economy over the next 6 years. The new tower is slated to be at Riverside South in Canary Wharf. Goldman Sachs, meantime, has also announced an expansion of its UK office in Birmingham following the budget, doubling its workforce in the city to 1,000. Karen, makes you wonder whether, the banks are coming out with all these offers now, with all these new investment plans, also offering to lower mortgage costs to extend more credit to the economy, simply because they're so relieved that they were spared from this budget. We saw the reaction in the equity markets yesterday, UK banks jumping, of course, as they escaped those new taxes, and they're up 62% since Labour took over. Of course, we'll have plenty more budget coverage this morning, including a conversation with the OBR's David Miles. That's going to be quite interesting, given the leak yesterday. That's coming up at 7:30 London time. And to catch up with all the details of the Chancellor's announcements, head to CNBC.com. Still coming up on the show as well, Airbus CEO tells CNBC he's betting big on space as the next frontier. We'll have the latest next. Plus, the ECB urges European lenders to boost their capital buffers in the face of rising risks from across the Atlantic. More on that later this hour. And the fallout from the UK budget continues. We'll have coverage throughout the morning, including an interview with the Reforms UK's head of policy. Tune into that interview. That is happening at 9 local time UK.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Quick check of U.S. markets for you overnight. We saw Wall Street extending gains for a fourth consecutive session. Take a look at the gains here. The Dow up by 0.75%. The S&P 500 rallying to the tune of 0.7%, and the Nasdaq also eking out some very respectable gains to the tune of 0.8%. What is driving these markets? Of course, all week it has been those expectations of a rate cut in the month of December. Futures now pricing in a 84% chance of a rate cut in the month of December. And of course, that continued AI rally. We saw Dell numbers yesterday, and they were very strong. The stock up by almost 6%. Now, keep in mind, of course, U.S. markets are closed for the Thanksgiving holiday, and that means volumes across the rest of the world will obviously be somewhat lower. Quick check of the Asian trading session as well. It is also lifted by that global risk appetite, Fed rate cuts, and AI, of course. Nikkei 2 to 5 up by 1.3%, almost the Hang Seng pretty much flat, and the Shanghai Comp eking out a modest gain here of 0.3%. Keep in mind the Nikkei back above that crucial 50,000 number. When it comes to European futures, this is the picture this morning, and keep in mind the stock 600 rising by 1% yesterday, also led higher by tech stocks. This morning looking a little bit more tepid. The FTSE 100, after yesterday's gain of 0.8% on the back of the budget, seemed down by just a tad. We talked about the outperformance in the banking stocks before. We'll see whether that can continue today. And the DAX is seen up by 0.1%. Now, the ECB is advising Eurozone lenders to strengthen their capital reserves, warning banks of a potential dollar squeeze. In its biannual financial stability review released Wednesday, the ECB said capital headroom could be needed to absorb higher currency volatility, and banks should hold liquid US dollar assets to counterbalance outflows. We asked ECB Vice President Luis de Guindos about the risk of higher valuations.
You have to bear in mind, the combination of all these factors, valuations, plus fiscal policy, plus, the situation of non-banks. I think that, what we have to look is, the combination of these elements. There is something that, we have indicated, we have included in our financial stability review that I think that is relevant, is how interconnected are the banks and the non-banks. I would say that, I would not say that, non-banks are the best clients of the banks, but they are becoming, one of the largest clients of the banks. So any accident that might happen in the non-bank space could have, repercussions in the situation of the banks. We have analyzed, the connection, the links between both. They are, very, very, very important. They are, there is a variety of connections. Not only, in the liability side of the banks, but as well in the asset side of the banks. And, the conclusion is that, the situation of the banks, from the financial stability standpoint is good in Europe, but we cannot ignore, we cannot oversee what's happening in the non-banks, because this could have, important spillover effects on the position of the banks. I know this is one of the main messages that we are conveying.
Yeah, your responsibility especially, of course, for financial stability in Europe, but the whole world is interconnected. So would you say that the US has a bigger risk of facing a correction, especially in the private debt and banking nexus, because private debt is even more important there?
Well, the activity of the private capital, the private equity and private credit is much more intense in the case of the US. But in Europe, it's going up. It's going up rapidly. So it's something that we cannot ignore. And I think that what might happen in the US is going to be relevant for us. Why? Because, for instance, if you look at the portfolios of the institutional investors in Europe, the concentration on the Seven Magnificent is relevant, is huge. And so, any correction there, could be immediately extended to Europe through this channel. I think that, the fundamentals, for instance, in terms of fiscal policy are different. But, markets are interconnected, not only, among different, players, but as well, from, different jurisdictions.
Chinese sportswear group Anta Sports is reportedly considering a bid for Puma. That's according to Bloomberg. The Hong Kong-listed company could reportedly partner up with a private equity firm if it decides to move forward with an offer. Other potential bidders for the German sportswear brand could include Li Ning as well as rival ASICS. It does feel as though times are tougher for the athleisure sector, well and truly past that post-COVID high when everybody was resorting to more comfortable clothing and shoes. And the reality, if you take a look at rivals in the space, very poor performance from Adidas, Nike. You saw Skechers earlier this year embark upon one of the biggest sneaker deals for the industry, consolidation, selling to private equity, 3G Capital. So there has been others too that have struggled through the macro, through the tariffs, the higher tariffs, of course, impacting the sector. And Puma itself had a sales decline of 1% in the first half, a tariff impact to the tune of about 80 million euros. The company we're talking about here, Anta, the Chinese company, it does have experience in the space. For instance, with Fila, Descente, through some of its subsidiaries, also with brand revival around Wilson, which you may recall, a big tennis brand, well known when it comes to the movie in the past about being stranded on an island, Survivor. This was one of the balls, of course, that was used. And Solomon in the ski space. So it is a company that does bring some expertise to the space, Carolyn.
Mm-hmm. You would think Puma is doing everything right. You know, they got a new CEO who was formerly at Adidas, obviously, its big German rival. You know, they're cutting their product range. They're also discounting less. They're improving marketing. So when it comes to the laundry list of what Puma should be doing, I think what the analysts argue is that, you know, this is the right plan of action. But there's one very big unknown in this space, in the fashion world, in the athleisure space, and that obviously is the unpredictability of consumer demands and what is cool and what is not. So how do you inject coolness into a brand? Is it through working with influencers, obviously? So I think this is the missing ingredient probably when it comes to Puma, because one shoe, one model can make or break your business, obviously, apart from the underlying operating performance. When it comes to Puma's biggest shareholder, this is quite interesting too, Karen. The French billionaire Pinot family, they hold 29% of the stake. But they have recently said that this is not a strategic stake and they're keeping their options open at this point. And also one final point I want to make here, Karen, is I'm surprised that we haven't seen a bid from Adidas yet. The big tie-up between the two German giants.
Well, that's the interesting thing. To me, as you talk about competition, it had to challenge Puma to get back into the game to take on very competitive Adidas and Nike. But while it was doing that, you had a whole heap of newer competitors from On to Hoka, and then in the actual apparel space, all of these new brands that are cropped up that everybody's buying. I mean, Aloe might be one of them, for instance, Lululemon. There are a ton of competitors, which means a lot of promotional activity at the same time when you've got a pressure on margins coming through from the tariff impact. To me, it seems like one challenge too many for Puma, and I wonder whether that would be the most desirable brand for Adidas to be buying at this stage. Might be homegrown talent, but could there be better purchases elsewhere to bulk up the portfolio?